Hello, I'm Kamyar Rezaie, and this is Minds of Commercial Real Estate, the show that takes you behind the scenes of the dynamic world of commercial real estate. As a commercial broker to high-profile clientele in Southern California, I've grown a deep passion for the real estate industry. And in this show, we'll be exploring all things commercial real estate through conversations with some of my close friends, colleagues, clients, and partners who share my passion for the business. Thank you for joining us for this episode. Please remember to give us a thumbs up, subscribe, and of course leave comments with any questions or thoughts you may have about the show. I'd love to hear from you. Welcome to Minds of Commercial Real Estate. Today we have a very special guest, Christine Gilmore with Chicago Title. Christine and I have known each other for over 18 years. She's one of the reasons why I'm still in the real estate industry. Christine, welcome.
Thank you, Cam. It's nice to be here.
So Christine and I, like I said, we go back a lot. One of my first deals I ever did in residential, Christine was my title rep.
Mm-hmm.
And she taught me a lot over the years. She's introduced me to many different lenders and clients. Christine, what do you see in the market today? You're on the other side representing the title companies and the escrows.
So this year, starting with last June, right, when interest rates started to spike up due to inflation, we've seen a lot of changes in the marketplace. I've seen more changes in the residential arena than commercial. A lot more challenges in the residential real estate market from a lending standpoint. Obviously, the affordability factor with interest rates being so much higher. I also think in recessionary times, obviously banks pull back. This is my third recession that I've lived and profited through, thank God.
Yeah.
Found a way to make it happen. But what I am seeing with banks is they're looking for partnering with the federal government, FHA, VA, government-backed, right? Lending, SBA loans. Banks feel very comfortable in these types of recessionary markets when they're partnering with the federal government and doing loans that involve. We're seeing challenges in terms of, qualification of people in order to be able to buy a single family residence. Interestingly enough, 30% of Americans own their homes free and clear, right?
That's great.
Another 33% of Americans have at least 50% equity in their homes. Those are huge numbers. People have a lot of money in their homes. So I was speaking to the operational director of City National Bank's residential real estate department. I handle their deals across the country. His brother happens to be a residential loan officer. And this will give you an example of what's going on in today's residential real estate market from a lending standpoint. He was working with a borrower whose wife and he had $88,000 in credit card debt. They owned their home free and clear. They were currently at a 3.5% interest rate. And that particular loan officer was having a very difficult time of getting that husband and wife to come off their 3.5% interest rate, full well knowing that their credit card debt was eating them alive. So people are holding on to their low interest rate, right? At the same time, the affordability factor of getting into a new home has increased exponentially, right? And so those two factors are pulling on each other, coupled with the fact that in America today, we're seeing that credit card debt is an all-time high. So I think next year is going to be a telling time. I get a lot of calls literally daily about where are we at with REOs and NODs. Real estate-owned properties and notice of defaults are when people have difficulty making their mortgage payment.
Right.
So if you listen to the national news media, right, the word on the street is that REOs and foreclosures are at an all-time high. But statistically speaking, they're at an all-time high from 0%. So 0% of zero is zero. So we're not seeing foreclosures. And the reason we're not seeing foreclosures in the residential real estate market is because people either A, own their home free and clear, or B, have a ton of equity, or C, have an extremely low interest rate, right? So with those three factors playing on each other, the residential real estate market has slowed down exponentially. Banks have been laying off. But I believe that there's always opportunity, right, Cam? And the opportunity in that residential real estate market comes from the ability that people will always need money, right? They send kids to college. They need to remodel their homes. They want to buy a second home. They need cash. And so historically speaking, people have always used their homes, right?
As a piggy bank.
Yep, as a piggy bank. So at some point in time, that's going to start to shift, and especially with credit card debt being an all-time high. That's what I'm seeing on the residential side.
And how about on the commercial side? With the deals that were going on in, let's say, 21, 22 versus this year?
So 2020 and 2021 and 2022, mounds and mounds of refis, right? When COVID hit, and Cam, you know this better than me because you're a commercial lender and I'm not. I'm on the other side of the fence, but commercial lending pulled out when COVID broke out in 2020. I remember clients were signing loan docs, right? And I don't know if you had any of these experiences, but commercial banks, pulled out on those deals at the time of borrowers closing because they were scared and didn't know what COVID looked like or how it was going to affect the commercial market. So that was the first thing we saw in 2020. And then 2021 and 2022 were landslides all the way through June, right? Everybody was refinancing, especially in the multi-family arena, 5+ units. Everybody was taking advantage of the low interest rates, and everybody was buying, right? Taking cash out of multifamily properties and commercial properties to buy second pieces of commercial real estate, right? Now, I would say 70% of the commercial transactions that I'm looking at on a daily basis, and I had about 4 of them come over this morning, they're either SBA loans, right? And I know you're doing a lot of those, 7As and 504s, or I'm seeing them out of the box and they're hard money. They're non-traditional. They're going to non-traditional financing units outside the bank. Right. So those are the two that I'm really seeing. The California real estate market is pretty savvy, right? As you know, our clientele, Cam, is savvy, and they understand real estate well. So I think in times that we're seeing right now with high interest rates and high inflation, people continuously, I get thousands of calls all the time, and people are asking me, what are prices of homes and what are prices of real estate going to do? Well, they're not going to do anything, right? We're 1.5 million homes in America behind in inventory. We have no inventory. So it's a supply and demand issue. There are not enough homes for people that want to buy. So therefore, prices are not going down. So if anybody's in the market to purchase, now's the time. And historically speaking, Cam, you probably know this, but every 10 years, prices of real estate double in Los Angeles. Sure. And if you look 10 years over 10 years since the turn of the century, prices of homes have literally doubled. So, and I bet I could ask you the same question, Cam, how much you bought your home for and how much it's worth today and the year you bought it. Right. And we could do the math. But it's always a good time to buy real estate in California, right? Only thing that really concerns me in the commercial space, what concerns me most in the commercial space in terms of strict commercial, being outside and not multifamily, is, with COVID and the way that people like to work now, or they have hybrid schedules where they're working from home and then they'll work from the office. And now a lot of companies that I work with, like major banking institutions, they're still only requiring their employees to go to work 3 times a week. So in that leasing space, it gets a little concerning, right? In the retail space, right? I think those owners are going to have to reimagine what they're going to do with their space, right? How they're going to utilize their retail space and what that needs to look like for 2024 and beyond. But I don't think it can be the way it's always looked like in the past. That retail space is a little concerning for me, and hoping that we're not going to have foreclosures in that area. In the multifamily space, I think our biggest challenge has been California's government, and the decisions that have been made on rent freezes. And they've been very adversarial towards multifamily owners. It's concerning. So a lot of people have left the state. They're not interested in investing in multifamily apartment buildings anymore in California. There's other states that are much more favorable and easier to have an ownership piece in that arena. So I've seen a lot of my large multifamily clients leave California, right? Coupled with the proposition that was passed, right? The mansion.
Sales over 5 million and 10 million.
Sales over 5 million and 10 million has really hurt. I mean, I think there's a backlash because when Gavin Newsom passed the 5 and the 10 million tax, commercial real estate owners are savvy. They're not dumb people. You don't buy a $5 million, building by being stupid. They understand real estate and they understand, everything that surrounds that asset that they purchase. And so they're not doing anything now. So I know they were talking about repealing that.
Correct.
Because the way I believe it was presented was not very forthcoming.
Right. There's a couple lawsuits, if I'm not mistaken, pending.
Oh, okay. I wasn't aware of that, but I think they're looking at that proposition and having that be repealed.
Right.
And I also know that, in the multifamily space, especially in LA County, because I have multifamily buildings, not only in LA County, but different cities, it feels very aggressive in LA County. My husband and I treat our tenants as if they're customers because they are. We treat them with great care and respect, and we also give them a great product. But it's been very difficult to be a multifamily owner over the last couple of years too, Cam. So it's been challenging,
right.
Very challenging.
Recently, they had the new law where next year they're saying a lot of the multifamily owners can increase the rent by 7%. They were speaking, it was in the news recently.
Mm-hmm. So yesterday in the city of LA, City Council proposed another rent freeze. That went on the block. But I think it's important to know that we've not been able to raise rents for 2 years, right? During COVID. And then that well after COVID had passed, the vaccines were out, and people were back to work in a normal fashion, they continued to carry forward the rent freeze. So I don't know, yesterday the hearing was at 4:00 before the city council in Los Angeles. I don't know what the outcome was, but I know that was that was a topic of discussion. So we'll have to see.
But the holding costs for like yourself in the multifamily has increased. Your insurance cost has increased, whether your loan has become variable, if it's fixed or not. So those are also factors which are, if you don't increase the rent, you're going to be paying out of pocket at some point.
Well, I mean, I think just by virtue of the fact that we're in an inflationary market, right? The cost of everything goes up. Electricity goes up, water goes up, goods and services go up. My husband was at one of our buildings today, and we were needing to we had a plumbing issue, and he was with a tenant, and we were going to have a contractor come in to fix the walls. It's all of it. It's wood, it's windows.
Correct.
All those costs go up. So as an owner, the costs keep squeezing us. And it's just the same as, wanting to, put minimum wage at $20 an hour. I think in essence, it sounds great. But then if you're a McDonald's franchise owner, and now Cam, you and I are working at McDonald's, and you have to pay us $20 an hour, what do you think the price of hamburgers and fries is going to go to?
They'll go up more percentage-wise.
So ultimately, everything, all the costs that are involved in everything we do, it ultimately gets thrown back on the consumer.
Right.
So I think it's always good to look at middle ground, rather than a rent freeze, and mind you, Cam, I was aware of very large international buyers that came from all different parts of the world that were slumlords, right? I saw that. Right. I saw them buying a building that was absolutely abhorrent, and would buy the building for, let's say, 5-10 million, do absolutely no work to the building, and double rents.
Right.
And so you have people that took advantage, right? And so now it's always a few bad apples that spoil it for the whole bunch. So now here we are, right? It's always the few people that do the wrong thing and then they hurt everybody in the process. So hopefully there's some middle ground. And a 7% increase in rent, you know, if you're paying $3,000 a month, a 7% increase is very expensive to some families.
Yeah.
And especially when groceries are up 30% and gas is up 40%, that's a lot for, somebody that's trying to survive. To
barely survive.
Yeah, so it's hard. It's unfortunate. Hopefully we can see some easing in inflation. I know that the Fed spoke yesterday, right? And they chose not to raise.
Correct. The prime rate.
Interest, the prime again. So that was good news, but it'll be interesting to see. I think most of the people right now, Cam, and you've probably seen this too, what types of clients are coming to you right now for commercial loans?
It's mainly the SBA people, mainly SBA. I'm not barely seeing any multifamily, but it's mainly SBA owner user. And, there's a lot of reports that were given out recently by Merrill Lynch and other major brokerages saying that in particular SBA's of medical office and office buildings is actually growing.
Okay.
And that's where we're seeing, like you said, the SBA loans, we're seeing a lot of the activity.
Okay.
And that's also where they're able to get the better rates. And that's the only space they can get a 25-year fixed amortized over 25 years.
Okay.
Versus if they go conventional, they're going to be most likely in a fixed period of maybe 3, 5, 7, or 10 years, and the remainder will become variable.
Okay. Yeah. I know that the banks love those practice loans, right?
Correct.
The doctor, attorney, the dentist.
Right.
The professional loans.
That's their favorite.
The condo buildings, right? So I've seen a lot of those and it's interesting because some of the banks have created that niche within their banks. So they're starting those departments.
Right.
For some of them didn't have them. And I also know a couple of banks got rid of them. And I happen to know because a regional manager at PNC Bank, they just got rid of their practice lending as a whole for that bank. So that was interesting to me because, like you said, when other banks are
growing
and you were doing more of those SBA practice loans, they shut theirs down. But there's always opportunity, right, Cam? And people always need money, and they use real estate as their credit card. So you have to find a need base, right? You have to find those people that need. So it's different.
It's a different market right now, but hopefully next year we're going toward the election year, and we'll see some changes, God willing.
Yeah, it will be interesting. Yes, and hopefully it will be a peaceful year. Even though it's an election year, it can still be peaceful, right?
Definitely.
Yes, that's what I hope for.
Looking at what we're facing right now in the economy versus what you saw between 2008 and 2011 from the Chicago title perspective, what's the difference?
Well, in the last recession that lasted 14 years, that's a big number, right?
Huge enough.
14 years, that's a long time to be in a recession. During that last recession, when real estate brought the American economy to its knees, like literally, right, Cam?
Right.
Interest rates fell drastically, right? It was a very different market. My concern under this current administration was stagflation, and that's exactly what we have. We have high interest rates coupled with high prices, and specifically in the real estate space, high prices of real estate, not only homes, but across the board, coupled with high interest rates. In 2008 through 2011, the short sale animal, right, came, meaning I owe more on my home. My home is worth less than I owe on it, right? So I bought my home for $1 million, but now it's only worth $600,000. That's a short sale. You owe more on your home than it's now valued. So it's a completely different market where people don't own properties, where they owe more on their home versus the value, because the values are very high. So we don't have a short sale market at all, number one. Number two, the federal government never wants people on the street, right? They want people in their homes. And number three, I'm not seeing a plethora of NODs. My real estate agents reach out to me across Southern California and ask me for NODs, for notices of defaults, for people that are currently not making their mortgage payment. And we're not seeing a lot of them. There's very few, right? Now, as people's loans adjust, because we have a hybrid of products, we have 3-year fixed, 5-year fixed, 7, 10, 20, 30-year amortization loans. As those loans get ready to come due, right, and their mortgage payment goes up or doubles, then you're going to have the concerns of people not being able to make their mortgage payment, and notices defaults start to increase. But we're just not seeing that yet. Hopefully we won't, but we're just not seeing it yet.
God willing, we won't see those.
Yes. Hopefully not. Yes. Hopefully not.
We're looking for the smooth transactions, the purchases, the refinances, so everybody's in their homes and able to keep all the properties that's on their portfolio.
Yes, absolutely. Amen.
Thank you, Christine, for being on the show. Look forward to closing our next deal in the next 2 weeks.
Thank you, Cam, for being my friend, first and foremost, and supporter all these years. And thanks for having me.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.